Welcome to the deep dive. We dig into all sorts of cool topics, and today we're going deep on behavioral investing.
Sounds fun.
Yeah. And we're going to be looking at The Little Book of Behavioral Investing by James Montier.
Oh, yeah, it's a classic.
It is, right? It's
Yeah.
one of those that a lot of folks who want to, not completely screw up their own investments really like.
Yeah, as Monty puts it, you don't want to be your own worst enemy when it comes to investing, right?
Totally. So let's just jump right in. One of the things that really stood out to me early on is this idea that we're kind of hardwired for optimism,
Right.
which makes sense. Evolutionarily, helps us survive, right?
Absolutely. I mean, the optimism probably helped our ancestors get through some pretty tough times. But when it comes to investing, well, not so much.
Yeah. So how do we how do we keep that optimism in check when we're thinking about investing? Can we even do that? Like override our natural instincts?
That's where it's helpful to understand the two systems that Montier talks about, the X system and the C system.
Okay, I remember those.
So the X system, think of it as our autopilot, right? It's fast, automatic, emotional. It's what drives those gut reactions.
So like when a stock starts tanking and you just want to sell, sell, sell.
Exactly. That's your X system in overdrive. And while it might have kept us safe from saber-toothed tigers back in the day, it can be a real problem when it comes to making smart investment decisions.
Okay, so that's the X system. What about the C system? It sounds calmer.
Yeah, much calmer.
Yeah.
Think of the C system as the thoughtful, analytical part of your brain. It's slower, more deliberate, and less swayed by emotion.
So Mr. Spock versus Captain Kirk.
Uh-huh, yeah, kinda. But the thing is, this C system, it takes effort to engage. It's not our default mode.
Right.
It's like, imagine you're cruising down the highway and suddenly, bam, a deer jumps out in front of you.
Oh, God, hate when that happens.
Right. So in that split second, it's your X system that slams on the brakes, swerves the car, prevents an accident. If you had to stop and think it through logically, you'd be roadkill.
I see. So it's good for split-second stuff.
Totally. But investing, well, it's not usually a life or death split-second decision. We have time to think things through.
Okay, so we need to get the C system in the driver's seat, especially when it comes to investing.
Exactly. And one of the key takeaways from the little book is that really successful investors, they figured out how to train their C system to take control. They don't let their X system call all the shots.
It's like building a mental muscle, right? The more we use it, the stronger our C system gets.
Absolutely. It takes practice and discipline, but it can really help us avoid those knee-jerk reactions that can really cost us in the long run.
So speaking of costing us, the book goes into some of the common biases that we all have. And I'll admit, I saw myself in a few of these, like overconfidence.
Oh, overconfidence. Yeah, that's a big one. I mean, we all like to think we're above average drivers, right?
Of course.
But the reality is, most of us aren't. And Montier points out that even professionals, like doctors, fall prey to overconfidence. They overestimate how accurate their diagnoses are.
Wow. So how does that play out in investing?
Well, overconfidence can lead us to take on too much risk, hold on to losing investments way too long, or not diversify enough because we're so sure we've picked winners.
It's like we're wearing those rose-colored glasses, huh? Blinding us to the potential downsides.
Exactly. And then there's confirmation bias. That's our tendency to look for information that supports what we already believe.
Oh, yeah, guilty as charged.
Right. Monty suggests a really simple exercise to combat this. He says, try reading an article a week from a publication that usually presents a viewpoint you don't agree with.
Huh. Yeah, that's a good one. Got to break out of the echo chamber every now and then.
Definitely. And then another bias that really resonated with me is the sunk cost fallacy.
Ugh, I know that one well. It's like when you keep pouring money into a bad investment just because you've already lost so much.
Yeah, or you're at a buffet and you feel like you have to eat everything you piled on your plate, even though you're stuffed.
The worst. So how do we get past that?
Well, it's tough because it's tied to our dislike of losing. We hate to admit we were wrong, but sometimes the best thing to do is cut our losses and move on.
Easier said than done, right?
It is, but it can save us a lot of heartache and money in the long run. And then there's action bias.
Action bias.
Yeah, that urge to constantly be doing something, even when doing nothing, might be the better move. Remember the example from the book about soccer goalies?
Oh, yeah, the penalty kicks.
Right. They're actually more likely to save a penalty kick if they just stay in the center of the goal. But they almost always jump to one side because it feels more proactive, like they're actually doing something.
It's like they can't just stand there and wait.
Exactly. And in investing, that action bias can lead to, well, over trading, chasing hot stocks, trying to time the market. And all of those things can really hurt your returns over time.
So how do we fight these biases? They seem so ingrained.
It's not easy, but Montier points to guys like Warren Buffett and Bruce Berkowitz. They're successful investors who figured out systems and ways of thinking that help them avoid these pitfalls. They focus on having a really disciplined process rather than just reacting emotionally.
So it's not about like being some emotionless robot. It's more about having a plan in place to help guide those decisions.
Right. A framework to help us make better choices. And a big part of that is recognizing the danger of market bubbles.
Ooh, bubbles. Always a fun topic.
Yeah, and they're actually more common than you might think. Montier lists over 30 bubbles since 1925.
Wow, that's a lot of bubbles. So why do they keep happening?
Well, the book argues that they're driven by, you guessed it, predictable human behavior. You see prices going up and up and up. FOMO kicks in, fear of missing out.
Everyone's making money except you.
Right. Then that overconfidence bias pops up. We start to like, this time is different. Those are 4 dangerous words when it comes to investing.
This time is different. I'll have to remember that one.
Definitely. It's crucial to understand how our behavior plays into these cycles. It's not about predicting the future. It's more about recognizing the signs that things might be getting a little too bubbly. One way to do that is to start thinking like a contrarian investor.
Okay, so contrarian investing, it sounds kind of scary, right? Like, isn't it risky to go against the crowd?
It can be, yeah, but it can also be really rewarding. When everybody's rushing to buy the same thing, well, that usually means the price is already inflated.
So contrarians are basically looking for times when the crowd is wrong.
Exactly. They're willing to go against the grain, maybe buy when everyone else is selling, or sell when everyone's buying.
It takes guts, though, doesn't it? I mean, it's hard to go against what everyone else is doing, especially if they seem to be making money.
Yeah, for sure. Montier talks about this, some neuroscience research showing that even just thinking about disagreeing with the crowd, it actually triggers our fear response.
Wow, really? So we're hardwired to follow the herd?
It seems that way.
What?
We want to fit in.
So how do we break free from that? How do we become more, I don't know, contrarian in our thinking?
Well, one key is to always be questioning those assumptions, and look for different perspectives. Surround yourself with people who disagree with you.
Makes sense, like that saying, if you're the smartest person in the room, you're in the wrong room.
Exactly. Expose yourself to different ideas, different opinions. That's how you develop your own independent thinking.
Earlier you mentioned Warren Buffett. He's a pretty famous contrarian, right? What can we learn from him?
Well, Buffett is all about the long game. He doesn't care about the day-to-day ups and downs of the market.
He just tunes it all out.
Pretty much. He's looking for companies that will be successful for years, even decades to come.
So he ignores all the short-term noise.
Right. He focuses on the fundamentals of the business. He asks himself, does this company have a real competitive advantage? Is it run by people I trust? Will it generate cash flow consistently?
So instead of getting lost in the weeds of the market, he's thinking bigger picture.
Exactly. And that takes discipline, a lot of it. It's about sticking to your strategy, even when it's tempting to stray.
I think for a lot of us, that's the hard part.
Yeah, for sure. Having a plan in place is super important. It's like that idea of pre-commitment.
Pre-commitment.
Yeah, it means making your decisions when you're calm and rational, not in the heat of the moment when you're feeling panicked or overly excited.
So like having a set of rules to follow,
Yeah,
no matter what the market is doing.
right. Like, what are your investment goals? What's your risk tolerance? How are you going to allocate your assets? If you have all that figured out beforehand, you're less likely to make impulsive decisions.
Makes sense. So we've got contrarian thinking, long-term focus, discipline, pre-commitment. Anything else we should be thinking about?
Montier also talks a lot about simplicity. We often think that more information means better decisions, but that's not always the case.
I can relate to that. I've definitely spent way too much time overanalyzing things.
And sometimes, having less information can actually help us make faster, more accurate decisions.
Really? So less is more.
Sometimes, yeah. Look at Buffett again. He's not spending all day staring at spreadsheets. He's trying to understand the simple story of a business.
So cutting through the noise and focusing on the essential stuff.
Exactly. Things like, does this company have a strong balance sheet? A sustainable advantage over its competitors? A management team that's focused on long-term value?
So instead of getting bogged down in the complexity, look for those clear signs of a healthy business.
Yeah, it's about finding those simple signals. And that simplicity often leads to better decisions. Now, speaking of decisions, one that a lot of investors struggle with is knowing when to sell.
Selling, right. It's like the other side of the coin, but man, it can be so much harder.
Oh, it is way harder. It's emotional.
Yeah.
Even when you know you should sell,
Yeah.
it's tough to actually do it.
It really is. It's like you get attached.
And that's where this whole endowment effect thing comes in. We tend to think things we own are worth more just because they're ours.
It's like that wine bottle example from the book, right?
Yeah, exactly. A bottle of wine that's gone up in value, the owner might not want to sell it, even though if they didn't own it, they wouldn't pay that much for it.
Yeah, it's funny how our brains work.
It is. And it's the same thing with stocks. We remember what we paid, we get attached, and it's hard to be objective.
So how do we get past that? How do we make those tough selling decisions without letting our emotions get in the way?
Montier has a good tip. He says, pretend you don't own the investment. Ask yourself, if I had the cash right now, would I buy this at this price?
Oh, I like that. It forces you to really think about it.
Right. It takes the emotion out of it.
Mhm.
Another thing that can help is focusing on the process, not the outcome.
You know, we've talked about process a lot today. Why is it so important in investing?
Because it helps us stay grounded. The market goes up, the market goes down. It's a roller coaster.
And you don't want to get thrown off.
Exactly. So you might do all your research, pick a solid company, invest in it, and the stock could still go down. It happens.
That's going to be frustrating.
It is. But if you trust the process, you're less likely to panic and sell at the worst possible time.
You're playing the long game.
Right. It's about making good decisions over time, not trying to win every single trade. And speaking of the long game, remember those market bubbles we were talking about?
Oh, yeah. Those are scary.
They can be, but remember they're often driven by the same kind of predictable human behavior patterns. You see prices skyrocketing, everyone's getting rich.
And you don't want to be left out.
Exactly. FOMO kicks in, overconfidence takes over, and people start making decisions based on emotions rather than logic.
So how do we avoid getting caught up in all that craziness?
Stick to the process. Look for those objective signals, not gut feelings. Are valuations way higher than historical norms? Is there a ton of hype in the media? Are people borrowing like crazy to buy stocks?
Sounds like if everyone's saying this time is different, it might be time to take a step back.
Right. Now, on the other hand, when everyone's freaking out and selling everything, that's often when the best opportunities pop up.
That's where being a contrarian can really pay off.
Exactly. But again, it's not about just doing the opposite of what everyone else is doing. It's about doing your homework, thinking for yourself, and trusting your process.
So behavioral investing, it's not just about understanding the market, it's about understanding ourselves.
That's it. The more we know about our own biases, the better decisions we can make.
Well, this has been a fantastic deep dive into behavioral investing. We've learned about the biases that can trip us up, how to become more disciplined investors, and the importance of thinking long term.
It's been fun. Always good to revisit the little book.
It is a classic, and I think one of the biggest takeaways is that, like Montier says, we're often our own worst enemies when it comes to investing.
It's true. But the good news is once we understand that, we can start to make better choices.
So to everyone listening, keep learning, keep exploring this stuff. It's fascinating, and it can really make a difference in your investing journey. Thanks for joining us on the deep dive.